private equity firms increasingly taking business from the broader syndicated loan market. The latest example of this can be found in a once obscure type of loan that's becoming more common. Kelsey, can you just give us a sense, what is this loan?
Yeah, so unitranche financings, sometimes they're called one-stops, are a type of debt structure that combines first priority and subordinated debt into one. And what we've really seen this year is that volumes for this type of financing have really boomed. It used to be pretty rare to see one that was larger than $1 billion. And in the last few months, we've seen several, including a $1.8 billion one for the new media and Gannett merger.
Okay, so these are concentrated bets made by private equity firms. Sometimes they get together and that don't necessarily delineate first lien, second lien. So what is the risk here?
So the risk for direct lenders or the private equity firms that are making these loans is twofold. For one, the pricing on unitranches has really compressed, so they're not necessarily being compensated for the additional risk that they're taking on. Second, sometimes these unitranches are chopped up and sold further, and those types of side deals haven't really been tested in restructurings or bankruptcies.
Wow, this is really interesting and brings us to Brian and our next topic, which is growing risk. There's been an increasing amount of distress seen in specific slices of riskier credit markets, and there is a question, how much should we care? I'm talking particularly about CCC rated credit.
Yeah, I mean, I hate to say it, but you don't want to paint it with a broad brush, to use the cliche. The feeling is that there's only 285 names in the CCC index, or bonds rather, not even names. And then there's 2,000 bonds in the broad junk bond index as a whole. So you look at names like Frontier Communications, McDermott, California Resources. These are bonds that have been really hammered, and that's really blowing out spreads. Compared to double Bs, single Bs are still very tight.
Right, and we've seen that the extra yield that investors are demanding to own CCC credit over benchmark rates has risen to the highest level since 2016. A lot of people saying this has to do specifically with energy, but it's not just that. You're seeing loan covenants starting to tighten up as people get a little concerned. You're seeing downgrades outpacing upgrades among junk-rated companies by S&P by the most since 2009. When do we start to care about all this?
Well, I think leveraged loans are the really interesting place to look at because it goes beyond just, is there a credit problem here? It's the fact that the investor protections are weakened. So you might see distress start to creep in even earlier than expected because people are starting to worry about, will they be protected in the event of some sort of distress or default situation, and they'll want to get ahead of that.
But right now, people are viewing this mostly as idiosyncratic-driven spread widening.
Yeah, I think so. I mean, the double Bs are below 200 basis points now, and that's tight relative to any time in the past 15, 20 years.
Which brings us to Craig, and some people are blaming the trade war for all of the tepid risk demand across the board on the margins. They certainly blame the trade war for some of the weakness we're seeing in the U.S. luxury real estate market, particularly in Los Angeles. Can you talk a little bit about that?
Yeah, there's been a really big drop in basically luxury condo sales in the third quarter. And what people are telling us is that condo sales are down 30%, and that really over the last couple of years, 50% of those purchases, roughly speaking, were from Chinese buyers. So that's really showing up in the numbers that the Chinese are having a harder time getting the money out of the country, especially for real estate deals, and that's really hurting the market in downtown Los Angeles.
How pervasive has the pullback in Chinese money been? I mean, has it just been in LA real estate, or has it been across the board in luxury properties throughout the U.S.?
You know, it's been across the board. I think it shows up in markets where Chinese buyers are a bigger percentage of that pool. So in a place like New York, there's a lot of factors to why we have a problem in our luxury real estate market. In Los Angeles, especially in downtown Los Angeles, condos are kind of new, and Chinese buyers were a big chunk of those buyers. So you're really seeing it show in those numbers.